The Vanguard UK Lifestrategy funds turned 10 years old in June this year, and since they were launched back in 2011, they've gone on to become the #1 retail investment range in the UK. But what do the next 10 years hold, and will what has worked for them continue to work for them? As a financial planner, I have millions of pounds of client money invested across this range, and for that reason, we do a lot of ongoing due diligence on Vanguard Lifestrategy. We want to fully understand what we're invested into, and we want to be sure that it continues to be a good choice as a core part of many investment portfolios. Is it still a good choice though? Or is it now time to start reducing allocations to Vanguard Lifestrategy? In this video, I'm going to outline my thoughts based on my most recent in-depth conference call with Vanguard themselves. The information I'm giving you is straight from the horse's mouth, so to speak, and my views are based on that information. If we haven't met before, I'm Bourne. I'm a financial planner based here in the UK, and I help people achieve financial independence early, tax efficiently. I do that by advising people on the correct use of wrappers, allowances and reliefs, and this channel is a place for me to share some of my knowledge with you. So if that kind of content sounds like it could be useful to you, why not subscribe to the channel? And with that said, let's get into today's video. So we're going to focus on a few areas today to help you understand Vanguard Lifestrategy a little more and whether it could be a good choice for your investments. The things we're going to look at in this Vanguard tutorial are: what is Lifestrategy? What does it invest into? What are the key characteristics of the funds? What are the rules that Vanguard stick to? How have the funds performed since launch? What concerns are there about Lifestrategy going forward? And are those concerns valid? How can you access Vanguard Lifestrategy funds? And finally, some exciting news from Vanguard that I'm going to tell you about at the end, so stay tuned for that. What is Lifestrategy then? Well, it's a range of risk-rated, index-based investment funds designed for the UK investor. It invests into global stocks and global investment-grade bonds. A little more on that later, with each fund in the range having a different fixed allocation to stocks and bonds. It starts with the lowest risk Vanguard Lifestrategy 20% equity fund, which holds 80% in bonds, to then the 40% equity fund, which holds 60% in bonds, all the way up to the 100% equity fund. Now, Vanguard are a huge global asset manager with a lot of experience managing index funds and ETFs. They were formed by the legendary Jack Bogle back in 1975, and their core beliefs are that in order to maximise long-term returns, you must keep costs to a minimum, and the market itself, so asset allocation rather than stock selection, will drive 80% of your return. So most investors are better off just buying the market itself with an index tracker rather than trying to beat the market through stock picking. Their case for keeping costs to a minimum is this: it's a zero-sum game. Before costs, half of all investments underperform. When you calculate the benchmark return from a group of investments, that return is exactly in the middle. So this group has underperformed and this group has overperformed. But when you add in costs, as this diagram shows, the benchmark moves because of those costs, which means that more than half of investments then underperform. So you should always pay attention to investment costs and keep them to a minimum. With Vanguard Lifestrategy, the aim was to distill these core beliefs into a retail investment range that followed a robust process of rules-based investing in order to produce good long-term investment outcomes. They wanted to build portfolios that were outwardly simple by purely investing into stocks and bonds, but inwardly sophisticated in how that was constructed. Now, some would argue that just holding those two asset classes doesn't provide the same diversification that other portfolios would, that would invest into property and infrastructure and commodities, for example. But more on that later. What they created was a range that invests globally on a market cap weighted basis, which means that it invests into countries and sectors in line with the proportion they make up of the global market. And they invest into those territories through low-cost index tracking funds. So if the US makes up roughly 55% of the global stock market, which it does, this would be the starting point for asset allocation. However, because it's a UK range of funds, To make the range more palatable to the UK investor when it was first launched, Vanguard decided to add a 25% home bias to UK stocks and a 35% home bias to UK fixed income, i.e. bonds. The reason that they did that was because when Lifestrategy was launched, the average allocation to the UK market in UK-based model portfolios was 62%. There wasn't anywhere near enough global diversification, but Vanguard decided that what they were bringing to the table was just going to be far too radical for most UK investors, so they decided to alter their allocations. This is about the only non-standard asset allocation call that Vanguard have ever made with these funds, because this is how they differ from practically all of their competitors. The majority of funds you see, whether they're active or passive, fall into one of these quadrants. That means that they aim to generate outperformance based on tactical asset allocation decisions, which just means they're going overweight or underweight in a particular country or sector because they think that country or sector is going to perform well or it's going to perform poorly. That's what tactical asset allocation means. Vanguard don't do that though. They proudly stand alone in this quadrant because all of their asset allocation is strategic, based on that global market capitalization. The reason that Vanguard don't do tactical allocation with these funds is simply because they think it's too hard to get right consistently. For tactical to work, you have to get a number of moving parts just right, including the timing and the tilt. Timing means knowing not only exactly when to buy into something, but knowing exactly when to exit that position too. And how big of a bet do you take? Once you've decided you want to go overweight in something, what do you go underweight in order to pay for that? That's the tilt. If you get any one of those calls wrong, you can detract growth rather than add it. Vanguard's belief, you see, is that the market is efficient because everybody has got the same information out there. So the price of something is probably what it should be. And that's why the best fund managers in the world only get it right about 60% of the time. If more people did get it right, there wouldn't be any reason for funds like Vanguard Lifestrategy. The fact that there is such a big demand is quite telling. How have the funds performed then? Well, the fact that they've become so popular probably tells you that Vanguard's philosophy, overwhelmingly to date, has worked. If we just compare the 60% equity fund, which is the largest fund in the range by assets managed, with its sector benchmark, which is the mixed investment 40 to 85% shares sector, you can see that the Vanguard fund, shown in blue, has outperformed over the last 10 years. Now 2011 was a difficult year for investments actually. After some fantastic growth in 2009 and 10 coming out of the global financial crisis, markets retreated a bit in 2011. But straight from the off you can see that the fund was ahead of its peer group and it's remained there ever since, delivering 113% growth over that period. So any money invested at the start would have more than doubled, versus 83% for the sector. Another important thing to look at is volatility. How risky has the fund been compared to its peers? And this chart shows that. You always want to be in this top left quadrant on a chart like this. This axis shows performance and this shows volatility across the bottom. So you want your performance to be as high as possible and your volatility as low as possible. And as you can see, not only has the Vanguard fund produced much better performance, it's also experienced less volatility, less risk than the sector. Now looking at the range as a whole, I think this chart best demonstrates how the funds have performed long term. This is based on back-tested returns from 2005 all the way to the end of September last year. And once again, this left axis shows annualized performance, so that means that would be 5.5% per year, 6% per year, and so on. And the bottom shows volatility. In any risk-rated range of funds, what you should see is the lowest risk fund starting somewhere in the lower left, with an imaginary straight line pointing upwards towards the right until it joins the highest risk fund, with all funds in between sticking pretty close to, but ideally slightly above, that line. Now that line would be what's called the efficient frontier. Any funds that fall below that line would be suboptimal because they wouldn't provide enough return for the level of risk being taken. And as you can see, This is exactly what you'd like to expect from a range of risk-rated funds. All good so far then, but what does the next 10 years hold? Will the same philosophy continue to hold true, or has the paradigm changed? In the press, you'll always find people who raise concerns about Vanguard's strategy. So let's explore some of these concerns and see whether they have any validity. So one is a perceived over-allocation to the US and to big tech in particular. Quite often I hear people say that Lifestrategy's US bias and the natural bias to big tech companies, commonly referred to as the FANGs, which is Facebook, Apple, Amazon, Netflix and Google, will hurt Lifestrategy if those companies see a decline. I was actually at an investment conference a couple of years ago. I won't name the company, but the chief executive, no less, got up on stage and said that Lifestrategy would be in big trouble if this happened because their model means that they've got about a 25% exposure to those companies. He was totally incorrect though, because what he was doing was basing that on an S&P 500 tracker. The S&P 500 being the 500 largest US stocks. And yes, if that was all Lifestrategy invested into, he'd be right. But it doesn't just invest into the 500 biggest US stocks. It invests into practically the entire US stock market, as well as the rest of the world. So if you invested into the Lifestrategy 100% equity fund, your entire exposure to those companies would be about 6.2% of the fund. And if you were invested into one of the other funds in the range, it would be less than that because you'd hold bonds as well. So I don't really see this as a valid concern because the funds do give plenty of diversification. And notwithstanding that, I don't really foresee the influence of the FANGs diminishing anytime soon anyway. Another thing I see written a lot is that bonds don't really provide sufficient diversification to stocks. This is always in the press, and really it stems from a lack of understanding about the types of bonds that Vanguard Lifestrategy funds hold. I'm not going to spend too much time explaining what a bond is here, but in essence, it's a loan issued either by a government or a company that pays usually a fixed interest rate for a specified period of time. Those loan issues are split up into little blocks that you can buy, and they're traded like stocks, but because the return is predictable, they're generally viewed as lower risk. It would be true to say that bonds as an entire asset class don't always sufficiently diversify your equity risk. In fact, in some cases they're positively correlated with stocks. But there's bonds and then there's bonds. This is a really interesting chart, I think, because it shows how assets performed during the global financial crisis of 2007 to 2009. Now, during that period, global stocks fell by 37%. Global REITs, real estate investment trusts, did even worse. These in the red box here are types of bonds. Global high yield bonds, for example, would be companies of lower credit quality, and they behave just like equities did. So did emerging market bonds. But look at these over here. Global treasuries, which are bonds issued by the US government, and sterling gilts, which are bonds issued by the UK government, grew substantially. That's because in times of market panic, money finds its way into these safe haven assets of very high credit quality, pushing their values up. Now, Vanguard Lifestrategy only invests into investment grade bonds with a credit rating of BBB or above, and the majority of their bonds are held in AA or AAA rated bonds such as these. So when people say bonds don't diversify, as a whole asset class they're right, but selectively the right sorts of bonds do. But some people might say, that was just the global financial crisis, that was a different set of circumstances, it was unique. Well, fast forward 11 years to just last year, the COVID crisis, different period, same picture. Obviously, it was a much shorter time frame, that was only 1 month, but the situation was the same. And the thing that really sets Vanguard apart is that most companies are trying to seek growth, and in particular yield, so higher interest rates, from their bonds, which means they end up fishing in this pool. And lo and behold, when it comes to the crunch, they find their bonds don't diversify. But Vanguard openly say, look, we're not aiming to produce return from bonds. They're in there purely as a risk dampener. Your return will come from equities, from stocks. If bonds do produce a return, great. But we're not going to change our strategy to try and seek yield there. And that is what sets them apart. So how can you purchase Vanguard Lifestrategy funds? Well, because they are so popular, they're available on all of the main direct-to-customer platforms like Fidelity and Hargreaves Lansdown. And you can also purchase them directly through vanguardinvestor.co.uk. They have the full range of funds on there as well as other Vanguard funds, and their platform charge is quite low at 0.15%. So your total cost of owning the Lifestrategy funds on here would be 0.37% with the fund charge added on top. As well as being available in a general investment account, you can hold them in an ISA, where all of your returns would be tax-free, and also a personal pension, where you can qualify for tax relief on your contributions. Another way, of course, would be by speaking to a financial advisor, who'd have access to these strategies too. And I'd say it's worth doing that if you want guidance on the risks and the taxation aspects. Remember that what I'm telling you here is for information and education purposes only. This isn't a recommendation from me to go out and invest into these funds. You must always fully understand any investment and all of the risks before doing that. So do I think it's wise to hold other investments as well as Lifestrategy then? Well, regardless of how good I think the Lifestrategy funds are, I do think there's always merit in holding other types of investments in your portfolio so you can access different types of assets. That's why platforms such as Fidelity, which give you access to an extremely wide selection of investment funds and strategies from lots of different providers, are worthwhile considering. And finally, some exciting news from Vanguard, having spoken to my contacts there, is that they're due to launch a model portfolio service in the UK very soon. They'll be using all of their asset allocation expertise and experience to put together slightly more bespoke portfolios. Now this is hot off the press. It's not available yet, and initially it will only be available through a single advisor-led platform, but I'm sure a wider rollout will follow that. I'll be giving you a full rundown when I know more, so if you're interested in learning about it, make sure that you've subscribed to the channel and hit the notification bell.